Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular Markets Review Breaking the Mould, I'm going to look at letters, Marmite and mobile data. All three of them are capable of causing a fuss in the week ahead because we have a trio of trading statements coming up from three FTSE 100 firms, and they are Royal Mail on Tuesday the 19th, Food to Personal Goods Group Unilever on Thursday the 21st, and mobile communications behemoth Vodafone on Friday the 22nd. So let's get going with Royal Mail, which is due to release a first quarter update on Tuesday the 19th. The government has long since sold all of its shares in the company, and at least some of the heat has gone out of the debate over whether the 330 pence flotation price was too low or not. Fans will say the 480p share price as I sit here means the deal went well. Skeptics will argue the company was undersold. This chart shows the share price since that flotation. The investment case for Royal Mail still largely rests with the dividend yield, which using a consensus forecast for the payout of 23p a share is around 4.7%. Boss Moya Green won't go into such detail with the Q1s, but she will give an indication of volume and revenue growth for the letters and parcels businesses as well as the group overall. Now remember that in 2015-16, at UKPIL, the British letters and parcels business, letter revenues fell 2%, parcel revenues rose 1%, making for an overall 1% sales drop. At GLS, the European parcels arm, sales rose 9% on an underlying basis, although Green did predict slower growth for this year. Other factors to watch include this year's £160 million cost-cutting programme, capital investment of £550 to £600 million, and a strong focus on cash flow to pay that all-important dividend at a company where neither the top nor the bottom line are expected to grow that much, if at all. Now, if the lack of growth but decent yield means Royal Mail's a bit of a Marmite stock, income hunters may be enthused, momentum seekers unlikely to get involved, then Unilever's the ultimate Marmite stock because it owns the brand. And the Anglo-Dutch food to personal care and hygiene giant is due to report interims on Thursday the 21st. Unilever also owns Lipton's Tea, Hellmann's Mayonnaise, Dove Skin Products, Domestos and many more products beside, and these brands do give it a degree of pricing power. Just look at the last 3 years, and Q1 2016 for that matter, to see how volumes have grown and how pricing and product mix have also added to sales. Trends in volume, price and mix will be important in the interims, while investors will also be checking out underlying sales and volume growth at the four key product areas of food, refreshment, personal care and home care. This chart here shows the trends in Q1, while this next one looks at the geographic underlying sales trends, where the US and Europe did poorly in Q1 and emerging markets did well. Now it's this spread of business, if you'll pardon the expression for the Marmite owner, that helps to explain why Unilever shares are up by around 15% since the UK voted to leave the EU. Only around 10% of sales go to the UK, so sterling's plunge potentially increases the value of Unilever's overseas sales. Now the big question facing investors is what to do with a stock that's attracting the tag of expensive defensive, since Unilever trades on nearly 25 times forward earnings with a yield of 2.7%. What price are you prepared to pay for relative safety during uncertain times? That's something only you can decide for yourself. Now finally we come to Friday the 22nd's first quarter trading update from Vodafone, whose shares are up a little bit since the EU vote, though nowhere near as much as Unilever's. One wrinkle here is that Vodafone's actually announced plans to start reporting in euros rather than pounds, but there are four key trends to watch. First, organic revenue growth. For 2015 this was 2.3%, with services at 1.5%, and that was based on Europe down 0.6% and Africa, Middle East, Asia up 6.9%. Second, let's look at the number of 3 and 4G customers, 72.5 and just under 47 million at the end of last year. Thirdly, broadband customers, 13.4 million at the end of last year. And finally, all-important data volume growth, that was 71% last year. Vodafone's really all about data, as it seeks to generate extra revenues and earn a return on the capital investment associated with 4G and Project Spring. Any earnings growth would be a welcome addition at a stock that's increased its dividend every year for the last decade and where the yield is around 5% based on consensus estimates, albeit with skinny dividend cover. Thank you for watching, and I look forward to seeing you next time.